This is a bonus episode of the Rental Income Podcast. And now, Dan Lane.
There's been a lot of changes in the mortgage market recently, and a few weeks ago, the Federal Reserve made a surprise half-point rate cut. Caeli, can you tell us what this means? Give us some background on what this means for the mortgage market.
Absolutely. So first of all, let me take a minute and explain to your listeners or dispel maybe some of the myths or misunderstandings that they get when we talk about the Fed fund rate. So first of all, everybody, this is the intra-daily trading rate between banks. That's what the Fed fund rate is based off of. Very different to our long-term mortgage rates that are bond-driven. The Treasury is the one most commonly measured for our longer-term mortgage rates. So just to differentiate those two, and while there is a connection clearly between them, they are very different indexes. I was one of those believers that thought that when the Feds met on September 18th, that we were going to hear them announce a 0.25 percentage point rate cut, when in fact they came out with the half, as you mentioned, Dan. I lost lunch based on that. I had bet out there and I got to pay for lunch. So I didn't get that one right. But as a result, what we found right afterwards, we did see some improvements to our long-term rates initially, probably within the first few days to week right after that announcement. But from then to now, if you've been watching this or even seen any of the headlines, you know that the reverse has taken place for our long-term rates. Interest rates are actually up. And the reason for that is that the inflationary metric or data that's been posted since the announcement, the economy is still too hot. So as a result, Wall Street has kind of taken it into their own hands and made the appropriate corrections for mortgage-backed securities as it relates to our long-term rates.
On today's bonus episode, Caeli's going to explain more about what's going on in the mortgage market and what this means for us as rental property investors. We'll take a look at what the mortgage rates are today for a rental property and go over a payment example with today's rates. And we'll see how much your payment could be if rates come down a little bit more. Caeli's also going to talk about a creative way to finance your rental properties. Joining us on the show today is longtime friend of the podcast, Caeli Ridge. If you've been listening for a while, you know she's been on the show a bunch of times and she's been sponsoring the show for years. We'll take a really quick break to thank our sponsors today. We'll come right back and we'll talk to Caeli. I want to let you know about a really easy way to track your rental income and expenses. It's an accounting software custom made for rental property investors. It takes just seconds to enter an expense or to record that you collected rent. It makes tax time really easy. Just run a report and give it to your tax person and you are done. They're currently offering a free 30-day trial. There's no credit card required, so if you don't like it, there's nothing to cancel. You can learn more and sign up today at rentaltrial.com. That's rental trial, TRIAL, rentaltrial.com.
Rental Income Podcast.
We're recording this on October 17th, 2024. So this is real-time information for anyone listening, but I think if you're listening in the future, you'll still get something out of this. But Caeli, when the Fed cuts the short-term rates, can you explain how that impacts mortgage rates? Because it's not like a one-for-one example, but the rates kind of trend down as the Fed cuts rates, or they should trend down, right?
They should in theory, but let me just start by in answering that there's so many different variables, almost unlimited amounts of variables that will play a role in determining with what the Fed has done and what actually happens with that long-term interest rate that could completely turn it on its backside. So let's just use the most recent example. The Fed reduced the Fed fund rate, that intra-daily trading rate between banks, by 0.5 point. So there is no metric that I can give that would say, okay, if the Fed reduces by 1/4 or 1/2 or whatever the number it is, it's going to yield 1/8 or a full percentage point or whatever the one-to-one would be. It doesn't work that way. There's too many other components at play, and those are going to be the things like the jobs report or the PCE, which is an inflationary metric that stands for personal consumption expenditures. That's the one that the Feds most closely watch. That's their favored inflationary metric, CPI, Consumer Price Index, foreign affairs, all kinds of things are going to help shape and dictate how the Fed's comments, and sometimes they don't even have to reduce the Fed fund rate. They just speak in a certain language, and we'll see some volatility to our long-term rates. So you've got to really understand that it's not going to be just one thing or two things. If I had to give somebody one way in which they could potentially try to forecast where interest rates were going to go, that might be the most reliable and certainly not foolproof, it would be the Treasury. The 10-year Treasury bond is the one that if you're tracking that and you're watching the ticker tape throughout the day or weeks, that one tends to measure or be in line with how you're going to watch the long-term interest rates move up and down.
Okay, so the Fed is going to meet two more times this year. They have a meeting November 6th and then another one December 18th. And what's the thinking right now? Like, what's the kind of the word on the street on what they're going to do at those meetings?
So I'm going to answer that directly, and then I'm going to give some context. I think that they'll probably reduce another quarter point in November. It'll be announced like you said, they meet on the 6th and 7th. On the 7th is when we will hear Mr. Powell state whether or not we're going to see another rate cut at that meeting. But the things that we want to be looking for where I may or may not be changing that statement are going to be on the 31st of October. We're going to get that PCE that I just mentioned. So they're going to be waiting on that. So depending on what that reading says, and then on the 1st of November or the first Friday of every month is when we get our jobs report. Both of those two pieces of information are going to shape what really happens when Jerome Powell makes that announcement on the 7th.
All right, so the rates have dropped quite a bit from where they were at the peak. Like, do you remember what the rates were at the peak?
Sure. I would say just make sure that it's prefaced by saying that it's very specific to the characteristics of the transaction that you're quoting. Okay, the difference in interest rate that someone might say at the peak for an owner-occupied versus what we're talking about most of the time between us is the non-owner-occupied side. All of those variables count, but I would say the highest that I probably saw it over the last couple of years was in the high 7s, maybe in the low 8s, credit score, loan to value, loan size driven. But I'd put it in that range, high 7s, low 8s.
Okay, so and the rates have dropped quite a bit from that, and we'll get into where the rates are here in a few minutes, but the rates went up pretty quickly. Do you see them coming down pretty quickly too?
Unless something devastating happens within the economy, no. And I would quickly just mention that, a lot of times we want it both ways. We want the economy to be doing great and we want interest rates to be low. And I think a lot of people just miss the detail that they're not mutually exclusive. It's really one or the other. The worse the economy is doing, the lower the interest rates are going to be, and vice versa. That said, I would also say that historically speaking, that interest rates do go up much faster than they end up coming down. So I would expect a slower burn on the way down. I do think that we are headed in that direction. I think trajectory is south for interest rates, but I think it's going to be or take a lot more time for them to level out to maybe the baseline that we hope back down in the 5s-ish, right, for our non-owner occupieds, if I'm going to guess. And I think that we're probably a good year and a half in timeline from now to then.
So real estate moves in cycles. And if you were to take a 1,000-foot view of the market, would you say that we're at the beginning of a cycle where the rates are going to be trending down and like that may translate to prices going up as the rates come down?
I am of the opinion that we are at the precipice of a new cycle. I think it's actually already begun, I'd say in the last couple of months, but right there kind of at the beginning. And I think that both rates and I'm not going to blanket statement this for the entire nation. Okay, there's pockets, there's markets, and it's always going to be very specific to the market. But I do think that a buyer's market is on the horizon. I think that home values are going to start coming down in certain markets. The appreciation rate in some places has been completely out of control, very unsustainable. So even though many would assume that as interest rates come down, then they think that the home values are going to go back up, I'm not sure I agree with that in a lot of markets. I think that we're going to see buyers having more opportunity to negotiate, whether it be price point and or seller concessions, closing costs, along with some reduction in interest rate.
Well, I mean, that could be really good for investors. I mean, if the rates are coming down and if prices do come down a bit, that could be really good for us.
I agree.
Yeah.
Now, obviously, the pushback there is people are going to say, well, what about, lack of inventory, et cetera? But remember, it's market specific. But in some of those markets, you guys know which ones they are. The appreciation values are just, they cannot continue in the same theme that we've been seeing. It's just not possible. They will start coming back down.
Well, let's talk about rates today. So can you give us an example of what an interest rate is right now?
Sure. And I think a lot of people will be pleasantly surprised by this news. So let's just set the stage. We'll talk about a purchase of an investment property. We're going to call it a single family residence. We'll put 25% down. Let's say that the loan amount's about $100,000, good credit, et cetera. You're probably looking at about 6.625 as an interest rate, and you're probably looking at about 2 points for that interest rate today.
Okay. Well, that's pretty good. That's really good. Yeah. Now, what if rates were to drop, say, a half point? Like, is that going to make, how much of a difference in the payment does that make?
Yeah, I'm glad you asked that question, because I feel like this is the piece that I'm constantly trying to put out there for investors so that they're doing that math, because without actually doing the math, there's a psychology about the rate itself. And people, I think, play themselves out of very substantial investments just because they hear a number. So to put it into perspective, let's just keep using our example. At about $100,000, the principal and interest payment at 6.625 is $648 a month. For each eighth of a percentage point below that, let's go to 6.5%. The 648 goes to 639. So what is that? That's going to be about a $9 a month difference, right? For eighth of a percentage point. So if we take it down a half a point in payment at 6.125, so again, 6.625 down to 6.125 is a half a point reduction in rate. The payment is $615. So, the mental math there is what, $33? Did I get that right?
Yeah.
It's not as substantial as a lot of people mentally expect the number to be, especially on the smaller loan sizes.
Okay. So there's not a big incentive, I guess, to wait for rates to come down. It's not like that's not going to have a significant impact on your cash flow. I guess just getting a better deal would really be the driver. If you can buy a property, negotiate a little harder and get a better deal, that's going to benefit you more.
Sure. And especially if you can get the seller to contribute towards the closing costs, right? A few percentage points, and maybe you can use those to get that rate down, if that were the case. But, I've got countermeasures to every one of those discussions, because I'm talking about rates all day long. It's the buzzword, right? Everybody wants to know about interest rates.
Right.
And what I would say about that is a few things. One, if you're holding out for the lower interest rate, and in our case, we're talking about $30 a month or whatever we said it was. The first thing I would say is that if the deal is a make or break over $30, there's something wrong with the deal, and I would continue to research and look for potentially another investment. The other thing is that if you're waiting, you may play yourself out of the deal altogether. And then remember, when we talk about layering in the advantage of tax, the tax benefit, and while this is secondary, I fully recognize, be sure to know that you're going to be less in the deduction of interest on the lower interest rate too. So there is checks and balances at work here. And for $30, I don't know that, in my mind, the float of the interest rate or the holdout for getting into real estate to look at it as an investment justifies the potential reward. Does that make sense? Maybe it's saying that another way. If, it's the difference between half a point and $30 on whether or not I'm going to make a decision to invest in this particular property in this particular market. I would argue that there's something else there that needs to be considered that the investor isn't seeing.
Yeah. I mean, you shouldn't walk away from a deal over $30. I mean, that's really kind of short-sighted. I think that you're going to get a $30 rent increase at some point, and that deal is going to be right there. So I think you're spot on with that. Well, one thing that I really like about having you on the show and sponsoring the podcast for so long is that you've got lots of creative strategies, and you're not just a lender that's just processing applications. Like you really help people kind of get a plan together and help them invest and help them build a portfolio. And I wanted to see if you could give us like maybe one of the creative strategies that you've used recently with one of your clients, just to maybe give us an idea of some things that we can do differently.
Well, first of all, thank you, Dan. Thank you for saying that. I really appreciate it. We work very hard to be as holistic a lender relationship as we can. So that means a lot coming from you. Yeah, I've got something that I think would be noteworthy. We have a loan product, and I think we've talked about it before. It's a first lien HELOC. And check this out. This is my absolute favorite loan product, especially for real estate investors, and it's going to take a minute for some people to wrap their heads around, okay? It's a first lien HELOC. Like I said, it's called the all-in-one. And if you've ever heard of the term velocity banking or infinity banking, that might resonate and connect a few dots here. But it is a way that you can utilize a open-ended revolving line of credit at your discretion so that you've become your own bank, theoretically, whereby I have clients that have, let's say, access to large sums of depository dollars and cents every month before it has to go back out the door. Okay. I'll give you an example so I can try and paint a picture here. Let's say that you have $100,000 in cash that sits idle or you can allow it to sit idle in an account for the majority of a 30-day billing cycle. Let's call it 29 days. And let's say that you have an outstanding balance on this HELOC of $100,000, just to keep the math simple. If you were to take your $100,000 in cash that's sitting idle, deposit it into this all-in-one loan vessel, it's going to drive that $100,000 balance down dollar for dollar. So for 29 days of that 30-day billing cycle, you're going to pay zero in interest. No interest will accrue because on any open-ended revolving account, think about a credit card, okay? Same principle here. You will only pay interest when there is a balance. So if you're an individual that has access to good depository income and then maybe residual income left over at the end of the month, the all-in-one product can greatly, and I mean by hundreds of thousands, greatly diminish the amount of interest that you would pay in comparison to, say, a traditional 30-year fixed mortgage. It's quite a tool that most investors, I believe, should have in their tool belt.
So just to walk through an example on that, like saying someone has $20,000, $30,000, $40,000 a month coming in rents every month, and your mortgage payment, say the rents come in on the first, you got $40,000 coming in on the first, and you're going to pay your mortgage on the 15th, you could save money by having that money deposited to your all-in-one account and then paying the mortgage out of that account.
100%. And the reason it's called all-in-one is because it doubles as both this line of credit, this HELOC, home equity line of credit, and checking and savings. So let's say you bank with B of A. Okay, you're going to replace your B of A checking and savings with this new checking and savings, which is an FDIC insured account. So exactly the same automation, exactly the same technology here that you would have over there. And you're just going to, nothing changes. Nothing changes about your spending habits or the monies you've got coming in or going out, but you're going to utilize these deposits in such a meaningful way and letting them sit and ride so that the interest accrual is so greatly diminished on a day-to-day basis that when you look at the math, the interest can't accrue. Because let me give you an example. Let's take, because a lot of times I feel like, Dan, this concept's very new to most of the people in this country. Mm-hmm. Okay, it's actually it's pretty popular and widely used out there in the rest of the planet. In the U.S., it's not so much. It's not as mainstream, obviously. So we are kind of preconditioned to understand that amortized mortgage, our 30-year fixed or our 15-year fixed. So I'm going to give you an example between a 30-year and a 15-year. So let's say that both of these loans start at $400,000 as the balance. And the 30-year fixed mortgage, let's say locked at 4% interest rate. The 15-year locked at 7%. People that don't understand amortization and they use that psychology about interest rate, they're automatically, without exception, they're going to run to that 4% 30-year fixed. They're not even going to think about it. I want the 4% rate. Well, when in fact, because of speed and that velocity of money, if you were to run the amortization, you will pay $40,000 more in interest, using my example, on a 4% 30-year than a 7% 15-year. So, and the reason for that is speed. Now, I know I'm not exactly comparing apples to apples. We're talking about two closed-ended amortized mortgages versus what I'm describing, or what we're talking about here, as an open-ended revolving HELOC. Totally different animals. But my point is speed. We've got 360 months on a 30-year fixed versus 180 months on a 15-year fixed. You can see that the time in which you are paying interest is what's at play here. So now come in, knock on the door, the all-in-one, the amount of time in which that interest is going to be allowed to accrue is the point that I'm trying to make. So because you can utilize this and become your own bank, as I've said, driving those principal balances down and really reducing the amount of interest that you're going to pay. The other thing I would say about this, guys, is that think about the first 10 years of any 30-year fixed mortgage. How much of your principal and interest payment is going to principal?
Very
little. Very, very small amount. That was rhetorical. I think most people know that the first 10 years, just a fraction of a percent is going to the principal. And why is that? Well, it's because, the GSEs, government-sponsored enterprises, the Fannies and Freddies, they want their interest, right? They're going to make their interest. And they know that historically speaking, you will be refinancing that mortgage, typically on an investment property, 5 years, 7 years on a primary residence. So they're keeping our payment low with the amortization. That's wonderful that we have access to that. But we're going to front load the interest so that they make sure that they get as much of it as they can before you go and either sell the property or refinance it for whatever reason, cash out refi, reduction in rate, etc.
Yeah, it's a very interesting strategy. And I'm sure someone hearing this for the first time has questions or maybe wants to walk through a real life example for them. What would be the next step if someone is interested in learning more about the all-in-one?
Well, certainly get in touch with us. And there's this really, really cool tool that I do a lot throughout the day, one-on-one. We share screen on a Zoom call or a Teams call. There's an online interactive simulator. And the really neat thing is the math will not lie. If you're a good candidate for this loan, it'll be very clear at the end comparing what you have now or what you might be getting in a 30-year fix, whichever, to the all-in-one. It'll be extremely obvious what your interest savings is going to be, whether or not this is the right move for you on a purchase transaction or refinance transaction. The simulator is pretty slick.
If you want to talk more with Caeli to see if the all-in-one makes sense for you, you can get in touch with her at 855-74-RIDGE or just go to ridgelendinggroup.com. Caeli, thank you so much for coming on the podcast. I'll be back with a new episode on Tuesday. My name is Dan Lane, and this has been a bonus episode of the Rental Income Podcast.